In 2007, one of Morgan Stanley's statistical arbitrage desks reportedly generated over $300 million in a single year, using market-neutral trades like pairs trading. At the same time, broad equity markets swung more than 15% peak to trough. While most traders were getting whipsawed by volatility, these desks focused on something different: price relationships, not price direction. In this video, we'll break down how hedge funds use pairs trading to target steady, market-neutral returns, and how a disciplined retail trader can implement a simplified version with Python. I'm the voice of AlphaEdge AI, where we turn quant finance and algorithmic trading into practical tools for systematic traders. Today's focus: pairs trading, a classic relative value strategy that goes long one asset, short another, and tries to profit from their spread reverting to normal. Fidelity describes it as a way to reduce exposure to market and industry risk and focus on the idiosyncratic spread between two stocks. By the end of this episode, you'll understand how hedge funds structurally use pairs trading inside market-neutral books, the statistical logic behind picking pairs and timing entries, a minimal Python framework you can adapt and test on your own, no magic, no promises of guaranteed profit, just the actual mechanics, with the data to back it up. Pairs trading sits at the core of many equity, market-neutral, and stat-RB funds because it targets relative pricing errors rather than outright market direction. Gatev, Gutzman, and Rowenhorst, 2006, studied U.S. equity pairs trading from 1962 to 2002 and found average annual excess returns around 11% after transaction costs, with relatively low correlation to the market. That's why institutions still care. At a high level, a hedge fund will screen thousands of stocks for historically highly correlated or co-integrated pairs. Monitor the spread between them, often a z-score of price or log price differences. Go long the underperformer and short the outperformer when the spread deviates beyond a threshold. Close the trade when the spread reverts toward its mean. Because each trade is dollar neutral or beta neutral, the P&L is largely driven by the relative move, not the overall market direction. That's why these strategies can potentially hold up even in down markets, providing what Fidelity calls downside protection and volatility dampening. Quantpedia summarizes a simple distance-based stock pair strategy with average annualized excess returns of about 10 to 11% in backtests, again with low market correlation. Real-world performance will be lower after modern costs and competition, but the principle holds. Professional desks don't pick pairs by eyeballing charts. They use systematic statistical filters. Correlation: pick stocks in the same sector with historically high correlation, say ZOO 0.8 over a one-year look-back. Distance or co-integration tests: Quantpedia's distance approach normalizes prices, then selects the closest pairs by historical Euclidean distance. More advanced desks use co-integration tests like Engel-Granger to ensure a stable long-run relationship. Liquidity and execution: hedge funds route orders algorithmically to slice into the market and reduce impact, often via broker or EMS algos. Then comes the trading rule, a classic version from Gatev et al. Compute the spread between normalized prices. Enter when spread z-score exceeds a threshold, like +2 or 2. Exit when the z-score crosses back toward 0. Risk management is not optional. Stop-outs: if the spread continues to widen beyond, say, 3 or 4 standard deviations, time stops if mean reversion doesn't occur within a preset horizon, e.g. 20 trading days. Portfolio limits, so no single pair dominates risk. Institutional portfolios run dozens or hundreds of pairs simultaneously, targeting portfolio-level Sharpe ratios above 1.5, 2.0 in benign regimes, but with systematic hedging against market and sector moves. Let's sketch a simplified, research-only workflow. This is not trading advice, just a starting point for your own testing. The basic steps: grab adjusted close prices for two stocks in the same industry. Normalize each price series, for example, by dividing by its initial value. Compute the spread as the difference between the normalized prices. Compute the rolling mean and standard deviation of that spread. Define signals: long underperformer, short outperformer when z-score 2. Short underperformer, long outperformer when z-score +2. Close when z-score crosses back through 1 to +1. From their disclaimer: this content is for educational and informational purposes only. Nothing in this video constitutes financial advice, investment advice, or a recommendation to buy or sell any security. Past performance of any strategy shown does not guarantee future results. Always do your own research and consult a qualified financial advisor before making investment decisions.